Every investor aims to see their portfolio grow, ideally outperforming the stock market benchmark index. Some investors achieve this through superior stock selection, while others strategize based on the business or economic cycle, investing in sectors known to thrive during certain economic phases. The business cycle consists of 6 stages. However, determining our current position and predicting the duration of each phase can be challenging. This complexity makes investment decisions tied to the business cycle a problematic task. Consider banks as a good investment choice when interest rates are going up. This is because when the economy is rapidly expanding, central banks raise interest rates to prevent inflation from becoming a problem. As a result, banks see a growth in their earnings due to the increasing cost of lending. Thus, investors tend to favor financial sector companies in an expanding economy. On the contrary, investors opt for defensive stocks or safe haven assets during a crisis. Utility companies, for instance, are preferred for their high dividend payouts, especially when interest rates are low due to central banks' monetary policy adjustments. The cycle begins with expansion, where economic growth resumes after a period of low growth or contraction. Stimulus measures such as lower taxes and increased spending may trigger this phase. Central banks typically reduce borrowing costs to encourage business and consumer spending. As a result, employers hire more labor, boosting in this way business and consumer confidence. Then comes the peak phase. Determining when an expansion phase has peaked is often a hindsight realization. Several factors could contribute to this peak, such as external demand and interest rate hikes by central banks in response to healthy employment growth. The recession follows after the peak, which is marked by 2 consecutive quarters of declining GDP. During this stage, hiring slows down, confidence levels fall, and businesses cut back on production. Then, depression ensues, that refers to a protracted period of economic decline. It is characterized by weak consumer and business confidence, reduced spending, and increased unemployment. Finally, the cycle closes with the recovery phase. Although it can be challenging to pinpoint the exact moment of recovery, the signs of it typically include the resumption of hiring and an increase in consumer spending. The economy eventually enters the expansion phase again. The business cycle affects in different ways various types of consumer-oriented stocks. For instance, consumer staples like food tend to sell consistently regardless of the economy's health. On the other hand, discretionary consumer items like cars sell better when consumers are optimistic about job security. Understanding the business cycle can help investors identify sectors that perform well during different stages. We use systems, like the North American Industry Classification System, to categorize companies into sectors with similar characteristics for a deeper understanding.